While the retail crowd debates over 1-minute candles and social media influencers scream about the next speculative breakout, the architects of the new global financial system are quietly securing the most mathematically scarce asset in human history. We have been conditioned by the legacy financial system to accept inflation as an unavoidable economic law. They tell you that your money must lose value every year, that supply must continually expand to keep the engine running, and that true scarcity is an illusion. But what if a sovereign infrastructure was built that defied that law entirely? What if the digital asset designed to settle quadrillions of dollars in global debt and derivatives was mechanically engineered to do the exact opposite? Welcome back to Crypto Report, where we read the architecture, not the headlines, and separate the structural signal from the market noise. Today, we decode the deflationary engine of the XRP ledger. We are conducting a first principles evaluation of David Schwartz's profound statement on mathematical scarcity. We detail the continuous transaction fee burn mechanism, expose the critical absence of inflationary validator rewards, and contrast XRP's pristine tokenomics against the inevitable supply inflation of gold, Bitcoin, and proof-of-stake networks like Ethereum and Solana. The era of inflationary dilution is officially ending. The era of the unprecedented utility-driven store of value is here. Let's get into it. Here's the hard truth that most participants in the digital asset space fundamentally misunderstand. When we talk about scarcity, retail investors immediately point to Bitcoin's 21 million supply cap. They point to gold's physical limitations in the Earth's crust. But there is a massive clinical difference between an asset with a conditionally capped supply and an asset with a structurally decreasing supply. Gold is scarce, but humanity pulls thousands of tons of it out of the ground every single year, constantly inflating the available float. Bitcoin's supply is capped at 21 million, but it is currently an inflating asset. Every 10 minutes, new Bitcoin is minted to pay network miners. Ethereum has implemented a burn mechanism, but it also continuously issues new tokens to pay its proof-of-stake validators, meaning its supply dynamics fluctuate wildly between deflationary and inflationary, depending entirely on network congestion and retail trading volumes. XRP is structurally and fundamentally different. It is a fully minted asset with a fixed maximum supply of exactly 100 billion tokens. No new XRP will ever be created, but the scarcity does not stop at the issuance cap. The XRP ledger features a continuous transaction fee burn mechanism. Every single time a transaction occurs on the network, whether it is a simple peer-to-peer transfer, a smart contract execution, or a multi-million-dollar cross-border settlement moving through institutional corridors, a fraction of a drop of XRP is destroyed, not paid to a central validator, not sent to a corporate treasury, destroyed, deleted from existence forever. Let us put this deflationary burn into mathematical context by examining the macro forcing function that is driving the institutional pivot. To understand why David Schwartz's design of mathematical scarcity is so revolutionary, you have to look at the broken mechanics of the legacy financial system. Currently, global cross-border payments rely on an antiquated messaging architecture known as SWIFT. SWIFT does not actually move money, it merely moves messages about money. Because of this structural inefficiency, financial institutions are forced to park trillions of dollars in dormant Nostro and Vostro accounts around the world. This is dead capital. It generates no yield. It is highly susceptible to inflationary decay, and it serves only as a pre-funded liquidity pool to lubricate the slow, fragmented corridors of international trade. In an era of tightening global liquidity and severe macroeconomic pressure, capital efficiency is no longer a luxury for these Tier 1 institutions. It is a mathematical mandate for survival. Banks and governments can no longer afford to leave trillions of dollars trapped in foreign fiat accounts just to facilitate global settlement. They require a bridge asset. They require an operational rail that allows for instant, mathematically final settlement without the crushing requirement of pre-funding. This is the precise structural friction the XRP ledger was engineered to eliminate. When you utilize XRP as a bridge currency for cross-border transactions through institutional payment architectures, the requirement for Nostro and Vostro accounts is completely eradicated. Capital is instantly unlocked. Settlement is finalized in 3 to 5 seconds. And this is exactly where the deflationary architecture of XRP becomes the ultimate catalyst. Every single time a bank, a payment provider, a central bank, or a Tier 1 asset manager utilizes this network to root value, that fraction of a drop of XRP is burned. The greater the utility the network facilitates, the higher the transaction volume. The higher the transaction volume, the faster the total circulating supply of XRP is systematically reduced. This is a brilliantly clinical design. David Schwartz and the foundational architects of the XRP ledger did not build a speculative retail token. They built a thermodynamic engine for global value transfer where the fuel is literally consumed upon use. The legacy banking guard initially fought this technology because it directly threatened their deeply entrenched monopoly on global financial routing. Today, they are quietly abandoning that fight and rapidly building the back-end infrastructure to adopt it. They recognize that in a highly leveraged global economy, choking on infinite fiat printing, holding an asset with a fixed supply is a strong defensive move. But utilizing an asset with a continuously decreasing supply that simultaneously powers instantaneous global settlement is the ultimate asymmetrical advantage. This brings us to the most dangerous misconception in the entire digital asset space, the market cap myth. Retail investors constantly look at the total supply of XRP, multiply it by an arbitrary price target, and conclude that a high valuation is mathematically impossible because the resulting market cap would exceed the gross domestic product of entire nations. This is a fundamental misunderstanding of how global liquidity actually works. Market capitalization is a lagging vanity metric. It is simply the last traded price of an asset multiplied by its circulating supply. It does not mean that amount of money is actually locked in the asset. When institutional capital flows into a fixed supply asset, it operates on a liquidity multiplier effect. Depending on the depth of the order books, $1 of actual capital inflow can increase the aggregate market cap by $10, $20, or even $50. But to truly understand the impending supply shock, we must take a forensic look at the actual arithmetic of XRP's supply and demand. Retail platforms will tell you that the circulating supply is in the tens of billions. The clinical reality is drastically different. The vast majority of XRP is locked in cryptographic escrow, tightly controlled and algorithmically released. Of the supply that is circulating, an enormous percentage is sitting in deep, cold storage, held by early adopters, institutional partners, and long-term accumulators who understand the end game. What is actually available on retail exchange order books and institutional over-the-counter desks is a remarkably small fraction of the total supply. Now, introduce the demand side of the equation. We are standing at the precipice of the greatest migration of value in human history, the tokenization of real-world assets. Larry Fink and the architects of traditional finance have openly stated that the future of markets is the tokenization of every stock, every bond, and every derivative contract. We are talking about a quadrillion-dollar global financial ecosystem moving on-chain. When these tokenized assets need to move across borders, across differing regulatory jurisdictions, and across disparate ledger technologies, they require a neutral, hyper-efficient settlement bridge. If even a fractional percentage of this quadrillion-dollar market utilizes the XRP ledger for instantaneous settlement, the demand for XRP on the open market will violently collide with a hyper-illiquid, actively deflating supply. As transaction velocity increases to handle global institutional settlement, the continuous transaction fee burn accelerates. More utility equals less supply. When you mandate the bridging of quadrillions in traditional tokenized assets through a fixed supply ledger that permanently destroys a portion of its native asset with every single ledger close, the eventual price appreciation is not a matter of retail speculation. It is a matter of unavoidable economic physics. Now let us examine the timeline and the regulatory convergence that validates this entire thesis. Retail investors look at market events in isolation. They see an exchange-traded fund filing, a new piece of legislation, or a major bank acquiring a digital asset trust charter, and they view them as disconnected headlines. Institutions do not operate in isolation. They operate on coordinated, multi-year timelines. What we are witnessing right now is not a series of random crypto developments. It is the synchronized, calculated rollout of the new global financial architecture. When you look at the recent filings for XRP exchange-traded funds, you are not just looking at a new investment vehicle for retail traders. You are looking at the foundational plumbing required for Tier 1 asset managers to hold and offer exposure to the primary bridge asset of the tokenized economy. When you see new regulatory acts moving through legislative chambers and regulatory bodies suddenly establishing clear frameworks for digital asset classification, it is not because they simply decided to embrace innovation. It is because the legacy institutions they protect have finished building their back-end infrastructure and are now demanding regulatory clarity to flip the switch. Look closely at the acquisition of national trust bank charters by major digital asset custodians. These charters are the ultimate regulatory golden tickets. They allow these entities to operate on the exact same playing field as traditional national banks, bridging the gap between legacy fiat and digital settlement rails. Every single regulatory hurdle that previously suppressed the utility of this asset is systematically being removed. The legacy financial system operates on a timeline of years, not days. When you see nations setting clear deadlines to reclassify digital assets under laws that govern institutional financial products, you are watching the final pieces fall into place. This means the window for the retail investor is silently and rapidly closing. We have officially moved past the what-if phase of digital asset adoption. The theoretical debates about whether blockchain technology will replace SWIFT or whether tokenization is a viable use case are definitively over. We are firmly in the when phase, and that timeline is being accelerated by macroeconomic necessity. The institutions are not waiting for lower retail prices. They are quietly accumulating. They are securing the mathematically scarce deflationary asset before the true scale of utility-driven demand hits the open public ledger. This brings us to the clinical verdict. The retail crowd is perpetually frustrated by sideways price action and manufactured market volatility. They trade on pure emotion, they panic sell at the first sign of red, and they ultimately become exit liquidity for the massive institutions that are quietly accumulating the float. Emotional trading leads directly to liquidation. Understanding the underlying architecture, however, is the exact blueprint for generational wealth. When you comprehend the mathematical scarcity of XRP, the continuous deflationary burn mechanism, and the strict absence of inflationary validator dilution, you immediately stop caring about daily chart fluctuations. You realize that you are holding the structural plumbing of the new global financial system. The legacy guard is not building this infrastructure to fail. They are actively building it to settle quadrillions of dollars in tokenized value, and they require a hyper-efficient, non-inflationary bridge asset to execute that mandate. Do not let the media noise shake you out of your position before the transition is complete. Stop obsessing over the current price and start focusing on the institutional plumbing being laid right in front of you. Stay patient, stay rational. We don't wait for the future, we plan for it. This is Crypto Report. See you in the next one.